Disadvantages and risks. Interest rate sensitivity. Perpetuities are highly sensitive to interest rate fluctuations. Rising interest rates significantly impact their value, potentially leading to substantial capital losses. This sensitivity is far greater than with bonds having a defined maturity date. Reinvestment risk. While the coupon payments are perpetual, the investor faces reinvestment risk. Future coupon payments may need to be reinvested at lower rates, reducing overall returns. Issuer default risk. Even though the payments are theoretically perpetual, there's always a risk of issuer default, particularly with corporate perpetuities. Governments are generally considered less risky, but default is still possible in extreme circumstances. Liquidity risk. Perpetuities are not as liquid as other fixed-income securities. Finding buyers can be challenging, particularly for less frequently traded perpetuities. This can impact an investor's ability to quickly sell their holdings. Complexity. Understanding and valuing perpetuities requires a sophisticated understanding of financial mathematics and market dynamics. Finding perpetual bonds. Historically, government-issued perpetuities were more common. However, their issuance is now less frequent. Some corporate entities have also issued perpetuities, often in the form of preferred stock with perpetual dividend payments. However, these instruments carry a higher default risk compared to government-issued perpetuities. Accessing these investments may require working with specialized brokers or investment advisors familiar with this niche market. Perpetuities in a portfolio context. Perpetuities can be a part of a well-diversified portfolio for investors with a high risk tolerance and a long-term investment horizon. However, they should be treated as a specialized investment, not a primary asset class. Their inclusion should be carefully considered alongside other fixed-income assets and equities to manage overall portfolio risk. It's crucial to consult with a financial advisor to determine if perpetuities align with your personal financial goals and risk tolerance. The potential for perpetual income is appealing, but the inherent risks must be thoroughly understood and managed. Conclusion. Bonds that pay you forever represent a niche, but intriguing investment opportunity. Perpetuities offer a theoretically unending stream of income, but this comes with significant interest rate sensitivity and liquidity challenges. Their suitability depends entirely on an investor's risk tolerance, financial objectives, and overall portfolio strategy. Thorough due diligence, expert advice, and a clear understanding of the associated risks are paramount before including perpetuities in any investment portfolio. This formula highlights the inverse relationship between the discount rate and the present value. A higher discount rate, reflecting higher risk or better alternative investments, reduces the perpetuity's value, while a lower discount rate increases it. This sensitivity to interest rate changes is a key characteristic of perpetuities.